Important factors of financial market. We all know that the monitoring authority uses the money market for diffusing the effects of its actions throughout the banking system and the economy, so as to promote growth with stability. In this lesson, we will describe the instruments or techniques of monetary policy, explain the factors affecting the interest rate, and the theories for determination of foreign exchange rate. After going through this presentation, you should be able to explain monetary policies and its objectives, define measures of money supply in India, describe interest rate dynamics, discuss interest rate forecasting, analyze the exchange rate dynamics, and understand the exchange rate arbitration. Monetary policy refers to the credit control measures adopted by the central bank of a country to influence the level of aggregate demand for goods and services, or to influence the trends in certain sectors of the economy. Monetary policy operates through varying the cost availability of credit. Objectives of monetary policy are: first is full employment. It is one of the objectives of monetary policy. It is not only because unemployment leads to wastage of potential output, but also because of the loss of social standing and self-respect. It also breeds poverty. Next is price stability. Another objective of monetary policy is to stabilize the price level. Both rising and falling prices are bad, as these bring unnecessary loss to some and undue advantage to others. They are associated with business cycles. So a policy of price stability keeps the value of money stable, eliminates cyclical fluctuations, brings economic stability, helps in reducing inequalities of income and wealth, secures social justice, and promotes economic welfare. Economic growth. Monetary policy can be imposed to influence the rapid economic growth. Economic growth is defined as the process whereby the real per capita income of a country increases over a long period of time. It is measured by the increase in the amount of goods and services produced in a country. A growing economy produces more goods and services in each successive time period. Thus, economic growth implies raising the standard of living of the people, reducing inequalities of income distribution. Next is balance of payments. Another objective of monetary policy since the 1950s has been to maintain equilibrium in the balance of payments. It is also recognized that deficit in the balance of payments will retard the attainment of other objectives. This is because a deficit in the balance of payment leads to a sizable outflow of gold. There is no unique measure to money aggregate. Money supply M equals to M1 plus M2 plus M3 plus M4. First is M1. It consists of currency notes and coins with public excluding cash in hand of all banks, demand deposit excluding interbank deposit, deposit held with RBI excluding IMF, PF, guarantee fund, and ad hoc liabilities, narrow money. M2 equals to M1 plus saving deposit with post office, saving bank. M3 is equal to M1 plus time deposit of commercial bank and cooperative bank excluding interbank deposit. It includes net bank credit to government plus bank credit to commercial sector plus net foreign exchange assets plus government currency liability to the public broad money. M4 equals to M3 plus total deposit with post office organization. The growth in money supply must be higher than the growth in the real national income. As income grows, the demand for money as one of the component of saving tends to increase. An increase in money supply is also necessitated by gradual reduction of the non-mentioned sector of the economy. In our country, the rate of increase in money supply has been far excess of the rate of growth in real national income. Interest rates are the price for borrowing money. Interest rates move up and down, reflecting many factors. The most important among these is the supply of funds available for loans from lenders and the demand from borrowers. How governments spend their money and finance is called fiscal policy. A high level of government expenditure and borrowing makes it hard for companies and individuals to borrow. This is called the crowding out effect. Another major factor in interest rate changes is the monetary policy of governments. If a government loosens monetary policy, this means that it has printed more money. Another very important factor is inflation. Investors want to preserve the purchasing power of their money. If inflation is high and risks going higher, investors will need a higher interest rate to consider lending their money for more than the shortest term. Interest rates are the price that lenders charge for lending their money to borrowers. The various components are: a real interest rate is the compensation over and above inflation that a lender demands to lend his money. Inflation is by far the biggest enemy of a lender. Lenders want a return on their money which compensates them for the inflation they expect and the risk that the inflation expectation could be wrong. The liquidity risk premium is the compensation that a lender receives for investing funds in something that is difficult to sell. The old adage, risk is having your money available when you need it, applies. Credit risk is the risk that the loan or bond will not be repaid as scheduled or at all. One of the frequent but least accurate financial forecast is the forecast of the future level of interest rates. Quantitative economic statistical techniques called econometrics attempts to model the economy using mathematical and statistical relationships. Interest arbitrage refers to the international flow of short-term liquid capital to earn a higher return abroad. Interest arbitrage can be covered or uncovered. First, uncovered interest arbitrage. The transfer of funds abroad to take advantage of higher interest rates in foreign monetary centers usually involves the conversion of the domestic currency into the foreign currency to make the investment. Second is covered interest arbitrage. Interest arbitrage is usually covered as investors of short-term funds abroad generally want to avoid the foreign exchange risk. The currency with the higher interest rate is usually at a forward discount. The net return on the investment is roughly equal to the positive interest differential earned abroad minus the forward discount on the foreign currency. This reduction in earnings is the cost of insurance against the foreign exchange risk. Exchange rate is the price of one country's money in terms of other country's money. When we say that the exchange rate of Indian rupee is 48.40 per US dollar, we mean that 48.40 Indian rupees are required to purchase $1. When this exchange rate becomes 48.90, we say that the value of Indian rupee has depreciated against the US dollar. On the other hand, when the exchange rate becomes 48.10, we say that the Indian rupee has appreciated against the US dollar. Inflation levels and trends. Economic growth and health and productivity of an economy are the economic factors. Financial factors that affect exchange rate are banking operations, speculative transactions, government budget deficits or surpluses, and balance of trade levels and trends. Internal, regional, national, and international political conditions and events can have a strong effect on the currency market. Exchange rate quotations. First, direct quote. In direct quote, X units of domestic currency equal 1 unit of foreign currency. For example, rupees 44.20 per USD is a direct quote for USD in India. Second is indirect quote. In indirect quote, the domestic currency is the commodity which is being bought and sold. Commodity comes first and price next. For example, rupees 1 equals to 0.02 USD. Next is conversion of quote from direct to indirect. Suppose rupees 44.20 equals to $1. This is a direct quote. Then convert into indirect quote. Therefore, rupees 1 equals to 1 divided by 44.20 equals to $0.0227. A spot exchange rate is a rate at which currencies are being traded for delivery on the same day. For example, an India importer may need US dollars to pay for the shipment that has just arrived. He will have to purchase the dollars in the market to make the payment for the import. The rate at which he will buy the dollars in the market is known as spot exchange rate. The forward rate is a price quotation to deliver the currency in future. The exchange rate is determined at the time of concluding the contract, but payment and delivery are not required till maturity. Foreign exchange dealers and banks give the forward rate quotations for delivery in future according to the requirement of their clients. International parity conditions provide logical explanation for the fluctuations in exchange rates. Balance of payments model focuses largely on tradable goods and services, ignoring the increasing role of global capital flows. Asset market model views currencies as an important asset class for constructing investment portfolios. Asset prices are influenced mostly by people's willingness to hold the existing quantities of assets, which in turn depends on their expectations on the future worth of these assets. Arbitrage is a financial transaction that makes an immediate profit without involving any risk. Technically, it consists of purchasing a commodity or security in one market for immediate sale in another market. The recently introduced futures index by the BSE and NSE is an instrument which can be used for arbitrage. Fair value is the summation of spot price and the holding cost. Holding costs could be cost of financing plus F equals to S plus C. However, if F is greater than S plus C or F is smaller than S plus C, then arbitrage opportunity exists. Now let us check if we have understood the various concepts discussed in this lesson clearly. A forward foreign exchange rate is the exchange rate at which one currency can be exchanged for another currency for settlement on a predetermined future date. Right or wrong? Right. Spot market does not operate during periods of hyperinflation. Right or wrong? Wrong. Exchange arbitrage involves the simultaneous purchase and sale of a currency in different foreign exchange market. Right or wrong? Right. Before we end, let us briefly revise what we have studied so far. Monetary policy is one of the two ways the government can impact the economy. By impacting the effective cost of money, the RBI can affect the amount of money that is spent by consumers and businesses. Interest rates are the price that lenders charge for lending their money to borrowers. The commercial banks are required to keep a certain amount of cash reserve, certain percentage of demand and time liabilities at the central bank. This percentage amount is called CRR. The rate of a foreign exchange contract for immediate delivery is called as spot rate. The FE quotations list selling price in dollars or foreign currency per dollar. The selling price refers to the price at which a large customer could have bought the currency from the dealers. A forward foreign exchange rate is the exchange rate at which one currency can be exchanged for another currency for settlement on a predetermined future date.